everyone. Good morning. I hope you're enjoying your breakfasts. Welcome to Bloomberg Invest. We are so thrilled that you're able to join us here in New York. We're going to put the spotlight on wealth management this morning in a program entitled Longevity in Life and Portfolios. So before we get started, I just want to give a big shout out and acknowledge our presenting sponsor, MassMutual. Thank you so much. All right, I'm in the news business, so breaking news. We're getting older and our portfolios need to keep up. According to the WHO, which apparently we're not part of anymore, the share of the global population that's at least 60 years old is expected to double by the year 2050 to 22%. So it's a lot of people to pay for in the next couple of years. You combine that with advancements in medicine and in science, and it's increasingly clear that both lifespans and health spans are extending out, right? They're increasing. So given this massive demographic shift, how do we ensure that future generations are prepared economically? Today, we brought together a mix of leaders in the healthcare space and wealth management space to discuss longevity in life as well as investment portfolios. But first, I do want to take care of some quick housekeeping stuff, some quick announcements. If you haven't already done so, please silence your phones out of respect for the speakers on stage. And once you've done that, please scan this QR code. Do we have the QR code? There we go. The QR code, it has everything you need for the event. It's got our Wi-Fi password, it's got the agenda, it's got opportunities for digital networking as well. And it will also have a tab that you can click on and write questions to our speakers. We want to hear from you, so write in anything that pops up and is top of mind as these conversations progress. And the way it'll work is that the questions will be vetted. They'll pop up on a monitor over here that we can see, and I promise that Cynthia and I will try our best to get to them. All right, so let's get this program started this morning. Continue eating your breakfast, please. But I want to bring up, to give us some brief opening remarks, Vaughn Bowman. Vaughn is CEO of MML Investor Services and Head of Wealth Management at MassMutual. Vaughn?
Thank you so much, and welcome everyone. Good morning. How's everybody feeling this morning? One day older than you were yesterday on the topic of longevity. You know, there's some things about getting older that you really never forget, and let me share something with you from my life. When I was a kid, I kept all my birthday money from when I was born to the age of 11 or 12 in a little blue metal lockbox that I kept hidden in my desk drawer in my bedroom as a kid. Until one day, I opened up the lockbox and I went down to see the local stockbroker. And I was an avid subscriber of Investors Business Daily, so I was clearly a really cool kid. And he had the nicest office in the strip mall, and I went with my mom and I bought my first stock. And ever since that day, my financial life has gotten more and more complicated. Now, 35 years later, I've got over 100 little blue lockboxes in my life. I call them my 401k, my IRA, my HSA, my 529s for my kids, my mortgages, and hundreds of other containers of my financial life. And if I'm lucky enough to be here 35 years from now, I know I'll have another 100 little blue boxes. And that's not uncommon. As we get older, and if we're fortunate enough to get wealthier as we get older, the complexity of our financial lives just goes in one direction, up. And as people are living longer and longer, that's more and more true, and as the world gets more and more complicated. Our job in financial services is clear. It's to take that complexity and somehow make it simple for clients. So the question is, are we up for that challenge as an industry? Preparing clients for decumulation when retirement can last 20, 30, 40, even 50 years is a whole new ballgame. So when you think about portfolio construction, asset allocation, tax planning, income planning, the rising costs of getting older. These are all things that everyone should care a lot about, because solving those problems is key to what we do for all our clients. In that light, I am extremely excited for this morning's panel, and on behalf of myself and MassMutual, I hope you really enjoy them. Thanks very much.
Thank you so much, Ron, for those opening remarks, and that imagery of lockboxes really gives us something to think about. Now, on the topic of longevity, we want to gain a better understanding of the scientific developments that are taking place in this area. So our next speaker is the founder and CEO of Cambrian Bio. He focuses on developing therapeutics that target the biological drivers of aging. Please give James Pyre a warm welcome alongside my colleague, Cynthia Coons.
Thanks for joining us today.
Cynthia, thanks for having me.
So we're here to talk about how to get so much older that you need all those lockboxes for all that money. And interesting that you've worked in this startup space on drugs that potentially will extend lifespan. You've started almost 20 companies, I think, in your career.
That's right, yeah.
Interestingly, though, the way the regulatory framework works in the U.S., the regulators are looking for drugs for specific diseases and conditions, cancer, high blood pressure. We've seen obesity in the last couple of years. Where does longevity fit in all of this? How does developing a drug in this space actually, how do you translate that into real life, into drugs that we would actually potentially get at the doctor?
I think in order to answer that, we have to ask the question, what will be the contribution of... Am I echoing weird? Does it sound okay to everyone? Sorry. What will be the contribution of all of these discoveries about aging biology to medicine, right? The reason that there's this huge upswelling in interest in longevity, it comes from basic research. People who worked on flies and worms and mice. And now we have 50 plus different interventions that can extend healthy lifespan in mice, for example. It's more than 100 in worms and flies. And so the way that we approach this in terms of building medicines that will be used by humans is asking first, what is the contribution that all of these discoveries is going to make? And the answer there is what we have on our hands is a whole new field of preventative medicines. Because how could you imagine, a drug for longevity? That's not really something that makes sense. But what is a drug for longevity doing? Well, it's preventing cancer and heart disease and frailty and all of the things that kill us. And if we aren't being killed by all of these diseases that happen as we age, then we live longer. And now when you reframe it that way and you're like, okay, well, what we've got is a preventative medicine, a new type of preventative medicine that could prevent multiple diseases of aging. Now you're like, it starts to look a little bit more like a real medicine. And so then we can ask a much more realistic question, which is how do you build a company, how do you build drugs that are preventative medicines? And the way that you do that is you identify a patient population who will benefit from these drugs in an acute setting. So from a FDA approval perspective, for example, you need to go through phase 1, phase 2, phase 3 trials, and preventing a disease is a hell of a lot more complicated to show that it works. Possible, but more complicated. And so the way that preventative medicines are usually approved is you test a drug for a specific disease, a specific group of patients that will benefit from that drug, from that mechanism. And then once you know it's safe and effective, then you test it for prevention. So we call that the stepping stone approach to get into a longevity drug. And so all of the companies that I founded in my life, first as an investor and then as kind of a company builder within Cambrian, they all fit this paradigm of finding a drug that can extend healthy lifespan in mice, then turning that into a biotech company going after a specific disease where we can show safety and efficacy. And then step 3 will be, now that that drug is safe and effective at treating a specific subgroup of patients, now can we use it for prevention in a way that maybe everyone in this room or everyone with certain blood biomarkers or after a certain age would want to take it in order to prevent disease. That's how, kind of grounding everyone, I think at the start of this conversation, that's what this whole hubbub about longevity is going to look like realistically for all of us, is new preventative medicines like a statin that lowers cholesterol, or like an antihypertensive that lowers blood pressure, but capable of doing so much more and useful for essentially everybody as they age. That's the real thing that's coming down the pipe.
So it's interesting to talk about this in this moment in time, because the obesity drugs that came out from Eli Lilly and Novo Nordisk in the past couple of years have been, scientifically hailed as game changers, but by the insurance community, there's been a big pushback about paying for expensive drugs that prevent outcomes. So curious where you see this debate going in terms of the likelihood that insurers will pay for it, since that's the biggest sort of access point and hurdle.
So we could really talk about this up and down. Let me first say that these obesity drugs are really good drugs, right? They really work well to reduce weight in a country where 40% of our population is obese. And every health economist will tell you that there is no more cost-effective way of kind of reducing overall costs in the healthcare system than through prevention. And it looks like reducing obesity has sort of positive knock-on effects in heart disease, in stroke, in diabetes, kind of all over the place. However, the way the American healthcare system is constructed is that the average time that a patient stays on their health insurer, I'm curious, since we have a lot of financial folks in the room here, it's only about 3 years. And so when someone is jumping to a new health insurer every 3 years, the game of the private health insurers is, it's like a game of hot potato. Why would we pay for prevention when we're not going to reap the benefits of prevention 10 plus years down the line? And so as part of the Affordable Care Act, and again, we're getting really deep into things, so I apologize. But as part of the Affordable Care Act, there was a group established called the USPMTF, U.S. Preventative Medicines Task Force, whose job it is to go in and evaluate preventative medicines. And if the data is good enough, then Medicare and all private insurers are forced to cover that. So that's kind of the pathway for a preventative medicine generally. The debate that's going on right now in the obesity space is whether these new obesity drugs even have to go through that USPMTF pathway, because that takes a long time. The amount of evidence that needs to be gathered is huge. With this obesity drug, or with these obesity drugs, there's this fascinating path where obesity has been kind of called, at least by the FDA, kind of called a disease. And so should insurers cover drugs for all diseases? Obesity is not really a disease in like the traditional way that we look at it. What it is it's a risk factor for multiple diseases like heart disease and so on and so on. But by framing it as a disease, that was certainly enough for the FDA to grant approvals. And the question is, will the insurance companies grant approval or reimburse around obesity as a disease state? If it does, it makes my life a lot easier, because having sort of biomarkers, if you will, like high BMI, is a great way for us to approve aging drugs and get those reimbursed. So, I mean, it's hard to look into this as like a crystal ball, but my view is that because these obesity drugs work so well, because every person who is overweight is either doing, like, getting their insurance to cover them now, or doing cash pay. About 40% of the sales of these drugs right now are cash pay. And because they work so well, the insurance system will cover them sooner or later. The question is, how much work do the big companies have to do in order to get them approved? But the health economic sort of case for this is super clear. Prevention is much more cost effective than waiting for people to have a heart attack or a stroke or need dialysis or something like that. That's way, way more expensive. It's just kind of how our system works right now.
And given the political climate we're in, and we've heard from a lot of things from RFK around diet and exercise being paramount to fixing the chronic disease crisis in America, Where do you think the conversation is going to go in terms of drugs as treatments for some of these things? I think there's sort of kind of conflicting narratives in some ways.
So you don't get into the startup world without being a bit of an optimist. And so when I was called up by a bunch of reporters to kind of comment on, oh, well, what do you think RFK and the new administration is going to do with this longevity space? And my view is that the science has just matured to a degree that no matter which side of the political spectrum you're on, you can't ignore this. Like this is just, in my view, the most exciting area of drug development and academic science that exists today. And so I think that the focus of the incoming administration on diet and exercise can kind of go one of two ways. It can either go in an anti-science direction of like, we don't want to touch medicines, but my sincere hope is that it'll go into a really positive strain, which is how can we get in front of disease, right? We do have a chronic disease epidemic in this country. We do make, we have food and exercise patterns that are not healthy for us. Those things can all be improved, but they won't be enough, right? We know from clinical trial after clinical trial that trying to impose diet and exercise regimes on people is not enough. We can nudge the system here and there, but the mentality behind saying, hey, diet and exercise are important is the same mentality that I'm using to come and say we need new preventative medicines for these chronic diseases of aging. The question is, if you'll let me, I know we're already kind of diverging, but the way I like to look at it is that we are evolved to become obese, right? If you look around the tables that you're all sitting in right now, how many pastries and sugar-filled things have we spread out there? Because we as humans love those things. We have evolved over the last, 200,000 years to be programmed to take every bit of extra sugar that we can find and put it into our bodies because we do not know when the next famine will come. And it's only been in the last couple of hundred years that has not been a problem for the majority of humans. And so now I think we have sort of two options. We can either play sort of a victim blaming game of like, well, hey, it's our fault that we are attracted to sugar. It's our fault that we can't control our appetites and so on. So be more disciplined. But what we know in clinical trials is that doesn't work very well. And then the alternative is to say, okay, well, how can we use science and the progress that we've made in understanding human biology to sort of reprogram ourselves to fit better in this new world that we as humanity have created. And that kind of framing in terms of sort of correcting or accelerating our evolutionary biology instead of blaming the victims, I say victims in air quotes, instead of blaming a person who has trouble getting up and exercising, has trouble not overeating, etc., why couldn't we create a medicine that makes that person more energetically active, that makes that person less hungry, like these obesity drugs? That's sort of a really interesting direction in terms of this big idea of how can we make humanity better suited to the world we have created that humans are living in. And so, anyway, it's a long way of answering your political question, but I think that's just sort of the direction that's being approached from both sides of the spectrum.
It's a nice segue into describing your lead candidate and what it does. How would you break it down for the lay person in terms of the type of science you're looking at and the role of metabolic health?
So the furthest along drug that has come out of this aging biology space in terms of clinical trials is a drug that I have the pleasure of sort of overseeing in its development. It's a drug, I don't know how many of you guys work in this, work or have looked at this space, but drugs always have three names, right? They have their brand name, they have their generic name, and before they get that, they have their code name. And so this drug is still in the code name stage. It's called ATX-304. And it does something really cool. It activates a pathway called AMPK and mitochondrial respiration, which are the two things that are responsible for declining in age that reduce our metabolism. So like if you could, most of us think back to our teens and 20s where you can kind of eat anything and never gain any weight, and then all of a sudden 30s, 40s, 50s, you're like, ooh, my body is changing a lot. The reason that that change happens is that our ability to activate AMPK and energy metabolism in the muscle goes down. And so we found a drug that can boost those things back up. And so you give it to a mouse or even a dog, and we see their level of energy expenditure just rise up 10, 15%. It's almost like some free exercise that you get in a pill every day. And with that increase in energy expenditure, their control of glucose, so their ability to get diabetes and so on, basically it gets so much better. You cannot give these mice diabetes. Even if you destroy their pancreas, they have no insulin, they will still not get diabetes because they're controlling their glucose so well. You put them on a high-fat diet, and even though their appetite doesn't decrease, in fact, if anything, it increases a little bit because they're like, Tour de France cyclists or something like that, using so much energy and then eating more and more and more, their weight will actually decrease. It kind of chews away from the fat, but not the muscle. Interesting versus the obesity drugs. And so anyway, we have this drug which works beautifully in mice, beautifully in dogs, and we're now in sort of the second stage of human clinical trials. We have a trial reading out for this drug actually in just a month and a half. So I joke that I'm running Schrodinger's company, that my company's either alive or dead, and I don't get to open the box with these blinded studies for a couple more months.
So Eli Lilly has rights to a similar drug. If you both succeed, how would you compete against the makers of Zepbound?
So Lilly has a collaboration with a company called Nimbus for a preclinical AMPK activator. We don't know whether it also activates the mitochondria. Again, this is a high-level conversation. I don't want to get too deep into it, but these pathways that are important in aging biology, they're not brand new pathways. They're often like the most important parts of cell biology. I like to call it getting into the guts of cell biology and tweaking those things in a way to reprogram sort of a old dysfunctional pattern to a young, more functional pattern. And both on the AMPK side and the mitochondrial activation side, big pharma companies have tried to activate these pathways for years. In fact, there have been 5 different drugs that were developed in mice and in cells that activate AMPK. All of them turned out to be toxic because they would drug development is like using a really blunt instrument, right? You come into the cell and you're like, I'm going to hit this thing as hard as I can to turn this pathway on or off. And when you turn that AMPK pathway on too hard with a blunt instrument, it actually causes too much sugar to go into the cell. And then it actually inflates the cell. The sugar precipitates. Anyway, we don't have to get into the scientific details, but it causes toxicity based on having too much sugar inside the cell versus outside. And so one of the magical things about these researchers studying longevity is that every discovery that sort of rises to the top has come into these really complex pathways and sort of tweaked and tuned them in a way that sort of resets them to a level of a youthful animal instead of coming in with this big sort of pharma hammer. And that's kind of been the theme of my career, is how can we, instead of a light switch turning a pathway on or off, how can we come in and use sort of a dimmer switch theme in biology? And that's sort of the magic of what this academic community has done, and kind of what our drug has done. But in any case, that's all aside from your question of what happens when we get these drugs approved. And a new AMPK drug would basically be the complement of the obesity drugs that exist today. The obesity drugs that exist today, they reduce appetite. They're almost like a crash diet, right? They make you stop eating, you start losing fat, you're also losing muscle at the same time. If you pair that with a drug that increases energy expenditure, then two really cool things happen. The first is if you pair it with the fasting drug right away, then you're both fasting and using more energy in your muscles. That prevents the muscle mass loss and increases the rate of fat loss in your body, number one. And then number two, most people only take these obesity drugs for about a year, and then they roll off. They're tired of the nausea, they're tired of not eating, et cetera, et cetera. And maintaining a person on these energy expenditure drugs for 2, 3, 5 years, that's going to be probably more what the paradigm looks like. And so you could imagine a situation where if I'm BMI 40, right, if I'm way overweight, I'll take both drugs at the beginning, lose 20 to 30% of my body weight, and then drop the GLP-1, drop the fasting drug, and then maintain myself on sort of a youthful energy metabolism, maybe as long as I'm around.
And do you envision a time where someone who maybe doesn't have a BMI to qualify for an obesity drug might get a drug like this for these benefits?
So that's really the dream, right? I like to call obesity the metabolic shortcut, looping all the way back to the start of our conversation of how you get preventative medicines approved, right? Obesity is kind of like preventative medicine already, but it's just for a subsection of the population who are already obese. And so as we're doing obesity trials, we're going to be looking at cancer rates, Alzheimer's rates, in addition to heart disease and diabetes rates that happen in these obesity patients. And as soon as you get enough data, all it takes is to make one shift and run an additional trial in non-obese patients in a preventative medicine study to see if you can prevent heart attacks and strokes and these sorts of things that happen in non-obese people as well. And so it's like, it's one extra step, but it's not that far of a step from saying, hey, let's just recruit obese versus non-obese people. So it's going to come if this thing works.
Well, there's a lot for us to keep an eye on. Thank you so much for joining us today. We really appreciate it.
My pleasure. Thanks for your attention, everyone.
Thank you, Cynthia. Thank you, James. Thank you for explaining why it is my son gets these sugar addictions and helping us understand all of that. Now that we have a better understanding of advancements that are happening in biotech, I want to welcome our next group of panelists. They are helping guide clients and portfolios to meet the needs of an aging population in today's volatile markets. Let's welcome them to the stage, Jimmy, Chris, and Holly. Let me just introduce our panelists formally. Jimmy Chang is Chief Investment Officer at Rockefeller Global Family Office. Chris Heisey is Chief Investment Officer at Bank of America Private Bank and Merrill. And Holly McDonald is Chief Investment Officer at Bessemer Trust. Welcome.
Thank you.
Was that me? I hope not. Okay, so we live in interesting times. I feel like we're talking about aging. I've aged this week and in the last 5 weeks. Your mission, your job is to invest for the long term, even though the short term feels like it's completely unknowable. What basic assumptions are you making as you invest for the long term? Holly, let me start with you.
Sure. So we are assuming we will be in a more volatile period than we have been in recent years. We are seeing that especially at the individual stock level in the market. And so within portfolios, we've actually kept a longer duration than the benchmark on the fixed income side, with the idea that concerns around tariffs will be more of a suppressant around growth expectations than inflation. And so far, that's providing some level of insulation.
Chris?
The first assumption is that earnings growth has to be there over the long haul. You get population growth mixed with productivity, you get earnings growth, and then you basically let the market dictate where valuation is. I mean, far be it for any of us to suggest 100 million, 200 million, billions of people investing are wrong if they want to pay 20 times earnings. So those are the basic assumptions, but also if you think about there's always a new innovation. The previous panel was fascinating to talk about science. There's always a new innovation that hits at the heart of all the negativity that's out there to reset and create this whole new paradigm. So those are the basic assumptions. And timing the market is a lot more important than timing the market.
Mm-hmm. Well, it's all about changes, and they appear to be accelerating, whether it's technology with AI or policies, domestic and international. We're somewhat optimistic. I think the destination will be better with deregulation, hopefully more discipline fiscally in Washington. But the path there could be very bumpy. So get ready for the volatile ride.
Yeah, we're seeing that right now. Just this morning, Howard Lutnick, the new Commerce Secretary, told Bloomberg Television that President Trump will later today decide on changes to the 25% tariffs that he just imposed on Mexico and Canada. There might be potential relief for certain sectors, like the auto sector. I know you're shaking your head. I feel that way too, because we'll be covering this later on, and the flurry of changes is hard to keep track of. I got to ask the loaded question. To what extent have you changed your strategy in any kind of meaningful way since Trump has returned to office? Jimmy, let me start with you. Have you done anything?
Well, really, since the election last year, we were anticipating potentially a bumpier market. The initial reaction is one of euphemism, a lot of euphoria. People were feeling great about U.S. exceptionalism. And we just felt that at the time, everyone was on one side. Everyone was uniformly bearish international. So we thought maybe you want to be more balanced. Maybe this Max 7 right has kind of run its course relative to the rest of the market. So we're talking about broadening out, becoming more diversified, actually be more nimble in a more volatile market.
Yeah, from our standpoint, it was more like the industry group changes, the sector changes. In terms of the broader market, being overweight equities relative to fixed income, tracking the better growth potential, but also deregulation filtering into a number of different sectors, particularly the financials, which should have a little bit more of a tailwind to them than they've had in the past few years. And then coming off of two very, very hyper growth years, particularly in the S&P with narrow performance, notwithstanding who's in the White House or what administration there is, just moving from that narrow leadership into a broader leadership was something that we had thought pre-election, post-election, and still now.
We have a quality growth theme within our equity portfolios. We've continued to lean into that. I'd say at the margin, really over the course of the past year, less tied to the election in any way, but just reducing some of the higher valued names versus some where we see more upside and essentially pairing names there. That's resulted in a slight reduction to technology overweight, but we still see a lot of opportunities there. I think just building on Chris's point earlier, it's easy to focus on the negative headlines, but there's just so many undercurrents of innovation in the economy that's really where you can compound wealth over time.
Okay, so you're making tweaks to your portfolios, but you're largely standing by what's worked in terms of earnings growth, in terms of innovation. Are there any assets that you're flat out avoiding? Because there's a lot of talk, for instance, Holly, about how much money is sitting on the sidelines in money market accounts and how there's $7 trillion waiting to make its way back into the markets. And so far, that hasn't happened.
I'd say one area that we avoid in our portfolios is crypto. Just throwing that out there. We're certainly happy to work with clients in their individual positioning, particularly as it may relate to their wealth planning strategies. There's some interesting topics there for another time, but we just see the volatility there likely to continue and just find, quite frankly, better value and more income earning or assets that can appreciate from an identifiable business strategy over time.
Yeah, no one particular asset per se, but when you think about company characteristics, companies that are not earning anything, don't have free cash flow, are highly valued, because there's still many of them out there that are hoping and promising future results, but they're simply not.
Do they have AI in their names?
What's that?
Do they have AI in their names?
Some of them might have AI in their names, yes, or at least on their conference calls. But I think staying away from those areas that were pure hope that earnings momentum was coming, that are highly valued, that have yet to correct and find the right price for them. Those are the areas we've been staying away. And it's been quite a long period of time now, at least over the last year and a half.
Jimmy, what about you?
I would say there's nothing you really want to avoid, given that at the right price, you can make a hand with anything. But obviously, when you look at the economic cycle, we've done really well over the last few years, and a lot of it was powered by deficit finance, stimulus from Washington. So as the new administration looks to somehow get things under control, I think the economy is likely to lose some momentum. So in that environment, you tend to underweight or shy away from lower quality, non-earning entities.
What about cash? Should cash be part of someone's long-term portfolio? I mean, I know the answer is no, but people are making a lot of money, relatively speaking, when they just stuff it in the savings account right now, because interest rates are still relatively high. Holly?
Yeah, I'd say with rates where they are, there is a higher bar for any investment opportunity. But especially as you're looking over the long term, cash is the one asset class that you know will not allow you to meet your financial goals over time, particularly given there is likely to be some degree of inflation into the future. So we really, Scarlett, have that as more just for specific liquidity needs. When we know that a client has that, of course, we'll insure those with cash holdings, but not as part of our longer term investment plan.
Bob Michael, the CIO of JP Morgan Asset Management, was on Bloomberg television this week, and he said dollar exceptionalism has ended this week, given all that's happened. Chris, you smiled at that. Do you agree? And how do you then position your portfolio if you believe that's the case?
You know, Wall Street, all of us have a way of creating these binary type of outcomes, or in some cases, major statements. I would say, to the degree that there was overvaluation, which nobody can argue with, there was massive overvaluation in the dollar, particularly against Asia. You know, I would also sit in the same car with Bob on that. But in terms of absolutely fading away, completely no. I think you're going to see some level of normalization. And what do you do with it? Well, you certainly have to put at the top of your watch list non-dollar investments. Jimmy was talking about that a little bit before. You saw some news out of Germany literally in the last 24 hours that provides a big change for them. And you have to watch that closely to see if it ultimately gets
The plans
passed.
to increase their defense spending.
That's right. Defense spending, overall 500 billion euro potential growth fund, et cetera, with infrastructure as well. And then you've got China probably adding more stimulus as well. So the question is if you get the third wheel, which is a weaker dollar that works into that, then the relative earnings overseas becomes a little bit more attractive. So that's at the top of the watch list right now.
How are you thinking about it, Jimmy?
Well, you need to differentiate between the tactical trading aspect versus the long-term global reserve currency status of the dollar, which is secure. There's just not a credible alternative probably for the next decade or more. From a trading standpoint, as Chris said, that near term, you can all feel that when you travel overseas, the dollar feels very overvalued, so there's an adjustment phase. But I would say it's probably going to be range-bound because fundamentally, as exciting as things may be with the European defense spending, they face big structural challenges, and similarly in the rest of the world, a lot of issues out there.
So you say that there's no credible alternative to the dollar as the world's reserve currency, but when something does come along, how will we know it? Won't it be gradually and then suddenly?
It will have to be something of sufficient volume. So let's say 5-10 years ago, the concern was that at some point the Chinese renminbi could become that alternative, given that their economy could at one point exceed the size of the U.S. At this point, it doesn't look to be likely, simply because China has gone back to become a lot more controlling of its economy. Potential growth has slowed down. And there's really no free float. There's capital control. So given that backdrop, it's hard to have it becoming a global reserve currency. And I can't see anything else of size that can compete with the dollar.
Okay, so U.S. dollar is safe for now, although we've seen how so far in 2025, the U.S. assets are kind of falling behind the rest of the world, right? European stocks were near record highs. They've come off of those levels. U.S. stocks have been underperforming relative to the rest of the world by the most since, I believe, 1994, according to Bloomberg Intelligence. That being the case, how do you position your portfolio? I mean, not just globally, right, U.S. versus rest of the world, even when you look across asset classes, the 60-40 portfolio, is it still relevant? Is it dead on arrival? What's your take on that? Holly, let me start with you.
Yeah, I'd say it's not dead on arrival, but it's certainly worth some adjustments, particularly as we're thinking about coming off of the last panel and longevity, people needing to have higher income and returning portfolios over longer periods of time. From my view, that 40 is probably too high in most cases. It should maybe more be like a 70-30 portfolio, an 80-20 portfolio. And then I'd say within that, what is making up the equity risk is very important. Having a sufficient amount of capital in private markets where we're in our case, we've been able to compound in excess of public markets, we think is quite important. And I'd say even on the fixed income side, evaluating other strategies that can be higher income earning, perhaps you give up a little bit of liquidity, but if you're looking over a 20, 30-year time frame, that's well worth the trade.
Chris, every time bond yields rise and it looks like there's correlation between stocks and bonds, and this happened plenty of times, this debate comes up.
Well, I think if you look back over 30 plus years, you had downward trending interest rates. We all know the reason why. That created a total return aspect of what fixed income was. And you mix that with equities. Whoever created the notion 60-40 probably should have reset it as interest rates were coming down. And once we reached zero, to Holly's point, you were probably something like 95.5 because there was no way for you to meet any kind of goal with a 0% handle. And now you're back to where we were in the 1990s again, 4 to 5% interest rates across the curve. So you're back to 60-40, 70-30 in those. And then how do you actually create within that allocation mix the right different streams given per unit of risk? And there's a number of different asset classes now that will allow you to do that. So from our standpoint is what is your goal? What is the role that each of those investments is going to play within that portfolio? And then ultimately use rebalancing. When volatility hits like it did yesterday, be ready. You mentioned cash before real quick. Cash should be there ready. And if you're going to use cash as an investment, that should be short-term fixed income.
Okay, so what, 6 month, 2 year?
Yeah, below a year or so. Because you're going to replenish, if you know you're going to replenish your cash flow, then going out to a year to pick up a little bit more yield makes sense.
Okay. Jimmy, the holy grail in all of this is looking for uncorrelated assets, things that don't move with the S&P 500, for instance. And Holly had mentioned private assets. Where do you fit in things like crypto, which she says she's avoiding right now, VC, which gives you access to new technology, to AI, for instance, physical assets like real estate or commodities?
Well, I would say all of the above, right?
Do you take it out of the 40? Do you take it out of the 60?
It's really, so to me, 60-40 means to have a diversified portfolio. And then tactically, you can make the adjustments. So we had this, as Chris said, this 30-40 year wave with downward earning, interest rate trends. So you can stay with fixed income. But now I think we're in a new era where rates will be kind of range bound with some catalysts driving it potentially even higher. So that 40 portion, you probably want to look at having some additional alternatives, private debt, for example. And on the equity side, depending on where we're in the business cycle, private equity could also make sense, given that you have new administration that's probably going to be more friendly, approving M&A, transactions that can help private equity. But at the same time, you're also facing higher interest rate, higher funding costs, which is a headwind to private equity. So I would say don't rule anything out, try to stay nimble, and 60-40 really means to be diversified.
Okay, so 60-40 equals diversification. Forget 60% equities, 40% fixed income. And just a reminder to all of you, please, if you have any questions for our panelists, again, the QR code that we had popped up earlier, if we could do that again so that you can scan it and send your questions to us and we'll incorporate them into our conversation. We mentioned private markets, so let's get to that right now. It feels like, at least on Bloomberg Television, every wealth manager and investment firm that we speak with is talking up private assets, private credit specifically. To what extent are your clients interested in private markets? They're seeking it out. And if not, why are they hesitant? Chris, what are you hearing? What are you seeing?
The awareness is going significantly higher. The interest is going higher. And a lot of it has to do with the fact that there's a lot more in the private market space. You've gone from venture capital and leverage buyout type of world to a number of different areas. Jimmy mentioned one before in terms of private debt, private credit. It is the highest growth area. You could see it in terms of financial sponsors. You can see it in terms of interest as it relates to the end investor, and then ultimately the person who's looking to take advantage of different types of fixed income. So all of this is kind of coalescing and converging together. What do we do with it? You're always looking for the illiquidity premium, number one, and you have to understand that those asset classes will ultimately create sometimes these gated functions that allow things to clear, and you have to understand that that illiquidity premium is there. You don't get an illiquidity premium when you're looking for liquidity. So you have to re-educate every time new asset classes are born, developed, and are growing. And the last point I would make is, make sure that you're with the correct managers.
Maybe if I could just add to that, because I've been observing this psychological effect of the liquidity give up. And speaking with our clients who, through often ownership of private companies, have generated significant wealth that can last many generations, there still can be a bit of a psychological hurdle to locking up some of that liquidity. But I think having a realistic perception of what one's own lifetime may look like, and also knowing that, wow, I may have enough liquidity to last well beyond my lifetime, so I'm really thinking about future generations. I think that leads the conversation into, I probably could give up more of that illiquidity in order to get that premium that Chris just mentioned.
The incredible returns that we've seen in U.S. equities, though, over the last 2 years, the public markets performance, that has to be some kind of barrier to wanting to make room in your portfolio for private assets, I would imagine.
Yeah, it creates a little bit of static nature on the part of an investor. It's like, I've done really well, I'm not sure, until you get a day like yesterday. And then you start to reconnect your emotions with either your advisor, your manager, et cetera, and you start to understand that your portfolio, at the end of the day, is a portfolio, and it's not a portfolio of one.
Right. What preconceived notions, Jimmy, do your clients come in with regarding private markets, private credit or private equity?
Well, I think the first question obviously is lack of liquidity.
Yeah.
But at the same time, you would expect finding premier managers, where manager selection is extremely important. If you look at public funds, equities, most managers tend to own fairly similar stuff. So there's a narrower range of dispersion. Whereas in private investments, the manager's skill really matters. That performance dispersion is really wide. So our clients count on us to do that due diligence and come up with the right access vehicles, the right managers. And that's really the challenge for most advisors trying to put their clients' money into private investments. How do you really identify and get access to the top quality managers?
I mean, okay, here's the other thing. We were talking about the liquidity issue and how it's not accessible, and if you want to bail out, you can't, like we saw in the public markets yesterday. In order to make it more accessible, we've seen ETFs come out that include private assets. The most recent one was PRIV between State Street and Apollo. The SEC later on sent a letter saying that they had all kinds of questions and issues with it. The ETF is still trading, but it was an example of how this is kind of a rocky path to get these kinds of products into retail investors' hands. What did we learn from that, Holly? Is there something to be taken away from this idea that we are trying to make private markets more accessible to individual investors, but there's going to be a lot of give and take and perhaps 2 steps forward, 1 step back along the way?
Yeah, it's very complicated. I think very early days in terms of some of these more liquid, illiquid products. I would say from our perspective, it really is important to work with the highest quality managers, especially if you think about a space like venture capital. Having access to those best managers is the name of the game. And the best managers who are more bespoke and niche really don't need to give more additional liquidity. So it's a little bit of a chicken and egg. I guess we're fortunate that I'm not really in the retail space, so I don't have to worry as much about it. But.
Right, but there are always people who think that they can do it themselves then, because there are products that are being marketed to people saying, sure, we've taken some of the work out. You don't need to go through your wealth advisor for the due diligence. Look, we've packaged it up nicely for you. Mm-hmm. Chris?
Yeah, I would say that the lab is always open when it comes to developing new solutions. And we've seen this come and go for many, many decades. And here we are again trying to create new products that in many respects make a lot of sense. Unfortunately, what ends up happening is in some cases you don't see that liquidity. You don't see enough assets coming into that new solution, and then ultimately kind of just fades away. So to Jimmy and Holly's point before, even though they don't have their own due diligence team, they really have to do their research before they start to move into something that's brand new.
Is there a tax issue to think about here when we're looking at private assets, Jimmy, for individual investors? I mean, beyond, just not looking at their 401k and expecting that it'll turn out okay.
Yeah, for a taxable account, it's more complicated with the K-1 versus 1099. So that's one consideration. But if you can put it in 401k, that probably make it easier. But I would say just be cautious with private equity, private investments, in that things look good when times are good. But as Buffett said, when the tide goes out, you'll know who's swimming naked. It's usually when you have a problem, you get the liquidity issue and then problem surfaces.
So in terms of private assets, let's talk about what you like, what you don't like right now, and how you're thinking about it. Chris, where do you stand on the different assets you can buy within private markets?
Well, private markets inherently are very long duration. So you have to think out 10, 15, 20 years as to where you think, growth will ultimately start here and continue to rise. If you're looking for that as a growth investment, stay high quality. At this point, Jimmy was talking about the level of rates. Your hurdle rate is higher now because of where rates are. But as you move into these different private assets, I would say infrastructure. And infrastructure can be anything, right? There's a big umbrella of infrastructure.
Physical, digital.
Physical, digital is a great way to think about it. You're talking data centers, you're talking redevelopment of infrastructure, port terminals, et cetera. Despite the fact of what we hear about trade, you're going to need that to get liquefied natural gas overseas, et cetera. So this is a long, long tail in the infrastructure space. That's number one. Warehousing is another one. So those are the areas within private assets. And access is absolutely critical because in many cases, local municipalities own them, et cetera. So in terms of being with the right manager, it's very critical to Jimmy's other point.
Holly?
So I would agree with Chris's point there. I'd say, broadly speaking, energy of all types and infrastructure related to energy is really important with the increased data usage coming from AI. So I see that a very long pathway there. And at the same time, more traditional venture capital that is looking at greater uses for AI, the healthcare space, just coming back to the last panel, biotech. It's kind of a barbell approach within our private assets program where some of the shorter term, safer short investments paired with some of these more aspirational longer term investments.
Jimmy?
I agree with my fellow panelists' views, yeah.
If
It's
you
an
wanted-
attractive space you want to be in, but the due diligence level is much higher.
Right, it's critical. That's what determines everything. If you wanted to invest in AI or look at AI and have that form a core part of your portfolio, how do you do that? Do you do that through public markets, NVIDIA, TSMC, or do you do that through private investments? I mean, just looking at AI as potentially an asset class in and of itself.
Well, I think at this stage it's still mostly public investments because you could participate in the whole ecosystem through the public market easily, right? Whether it's building data center, increasing power grid capacity, transport of energy, natural gas storage, pipelines, to building servers and putting chips. You can pretty much do it through public investments. But there will be private opportunities. So, for example, in the real estate space, a lot of data center requirements that will need funding. So there are REIT vehicles you can participate in. So I think it's a combination. But the quick access is really via the public market at this point.
Yeah, in terms of the way we think about the public markets, in terms of generative AI, is you're probably still in phase one on the way to phase two, which is it's no longer conceptual. The build-out is obviously happening, and then the build-out's going to be even bigger because the first build-out now can't even keep up with what the advancements are. So you think about the public space, you think about the builders of it, so the guts of generative artificial intelligence, the generators that are going to generate the power needed to be able to see this happen, and then ultimately the users. And that's where it gets really important. I think Holly was talking about medical advancements, life sciences, healthcare, and efficiency gainers. Like, that's the critical part. If you consistently think about where we are, we're going more and more towards asset light, less fixed labor, less fixed costs. And by that development alone, the need for heavy assets is going to increase. So it's like the biggest barbell ever. So that's where the private markets come in. That's where the more of the heavy asset end, and then new companies that are building the next generation of GAI in VC, in venture capital.
Okay, as we wrap things up on our discussion, I want to get your final thoughts, and I've asked each of you to think about what's the single biggest long-term opportunity that you see, and what's the single biggest long-term risk that you see. Holly, let me start with you.
Sure. So maybe I'll start with the risk. It's going to sound very basic, but I think given the long-term focus of our discussion, inflation and taxes are the biggest risk to wealth over time. So having a plan that ensures that you'll have those assets over not only your lifetime but generations, I think is really key. In terms of opportunities, I think I'm most excited about the confluence of technology in healthcare and looking out, specifically AI, more personalized diagnostics, personalized care. I think that's wonderful for humanity and will be great in our portfolios as well.
Good for your money and good for you.
Yeah. I think opportunity and risk is almost the same thing. The opportunities over the next decade, we'll be willing to say that you might experience the second, third best, or somewhere around there, bull market in equities, which includes world equities, in the next 10 years, mostly because of this asset-light theme that is constantly moving forward, which creates higher multiples, frankly, because you have more private capital. But at the same time, the risk is that private capital gets crowded out because of the debt. Now, the fix to the debt, ultimately, we talked about Wall Street creating interesting solutions. Well, there could be an interesting solution to help finance the debt through growth, not necessarily through higher interest rates. So big worry is the national debt, but don't focus too much on it. There's a fix out there for it.
How come no elected official has talked about it that way?
You have to get more creative.
Okay, note to Washington. Jimmy, what about you? Single biggest long-term risk, single biggest long-term opportunity?
I would say the single biggest risk and opportunity are both AI. Just because as we approach and at some point attain artificial general intelligence, the potential changes are so massive in all areas, whether it's job market, socially, welfare programs, how countries compete, the inequality widening, potential widening, income inequality, wealth gap. But if I want to be more practical, pertaining to longevity, financial planning, I would say that the bigger risk is also the U.S. unfunded liabilities. Can your clients count on Medicare, Social Security decades from now? Those are big questions. And that means you guys have to do a better job investing for them.
That's a lot of existential points to bring up. Very quickly, before I let you go, do any of you use AI right now in your day-to-day job for managing money?
We do, yeah.
How do you use it?
I'd say it's most useful within our equity research process, within our internal portfolio teams. Some of the more laborious, non-judgment related, but just compiling data and information. It's very helpful.
No, not true generative artificial intelligence. Large language model usage and things like that, and screening and querying, yes, but not true generative.
So keeping it old school.
Yeah.
Yeah, it's more in efficiency, gathering information, summarizing earnings calls.
Okay. Let the robots take care of that, right? I want to thank you so much, Holly, Chris, and Jimmy, for joining us today. Really great conversation. Thank you also for being such a wonderful audience. I hope you enjoyed your time this morning and your breakfast. You learned something new. Once again, I also want to thank our presenting sponsor, MassMutual, as well. Bloomberg Invest continues down the hall. We'll be starting at that stage at 10 a.m. sharp. So please get over there, get your seat, and enjoy the rest of the conference.